Welcome back to QAV. This is episode 441. We're recording this on Monday, the 11th of October, 2:20 p.m. Brisbane time, 3:20 p.m. Sydney time. How does it feel to be free, Tony? It's Freedom Day in Sydney.
Freedom Day. Oh, God, it's raining here. I just went for a walk and got soaked, so I think I'll be staying inside all week.
Were you listening to George Michael's Freedom song as you walked around? Freedom, I won't let you down. I won't pick you up.
Freedom. Yeah, it's strange that restaurants are open, people are out without masks on. It just feels like I've gone to a strange country with strange customs.
Yeah.
And I still can't book anywhere. I'm 2.5 weeks away from having a haircut. It's really annoying.
I like your mullet. I think it's good. You're bringing it back. You're rocking the mullet, the 80s mullet. Well, very exciting. Not so exciting down in Melbourne. Still pretty bad down there. But apparently, Melbourne Cup's going to go ahead. 10,000 people going to be at the Melbourne Cup on November 2nd. So. Yeah,
and one of my friends has a horse running too, so I'm hoping that they can get to see it, at least.
Has the horse been double vaxxed?
I don't think you double vaxxed. The jockey has.
Oh, okay.
Yeah, they have. The owners have. Hey, speaking of horses, my horse won yesterday on your birthday too.
And I didn't have a bet on it.
Ah, that was your birthday present. I got $11.50 for the win. Come on.
What horse was that?
Never Say Nay.
Really? It had a win?
Yeah.
Wow. Congratulations. That's a first.
Now I know why it won. You didn't bet it. You didn't back
it. That's great for you.
Oh, it was. It was a great feeling. Won really easily, and I look forward to it, improving onwards and upwards.
Good stuff. Well, speaking of onwards and upwards, let's talk about hydrogen, Tony.
Wait on. What about your birthday?
We don't want to talk about that. Yeah.
Come on, happy birthday.
Thanks. Yeah, I don't like birthdays. But it's my twins' birthdays today. They're turning 21. That's kind of weird, isn't it, when your kids turn 21?
Huge milestone. It is, yeah. It happened to me last year.
Yeah, I remember. We're not throwing I think they're going out to dinner with their mum tonight. We're not big. They're like me. They're not into parties. They're like, got too much work to do. Move on. Let's get it done.
What work is Hunter doing?
Making TikToks.
Oh, right.
He's got to make TikToks.
Right. That's
too many
called
TikToks
work these days, is it?
Well, yeah, for him
it's
work.
Right up there with podcasting. Yeah.
Yeah. And thanks to all of the QAV club members that sent me nice gifts. I really appreciated that. Let me see. There was none. Okay. Hydrogen futures. There's a new $1 billion project been announced by Anastasia and our mate Twiggy Forrest.
Ooh.
To build a massive green hydrogen production facility in Queensland. So I was running around looking for the hydrogen futures in commodity stocks to see what that's looking like.
I doubt if there is one.
I'm wondering if this is why Elizabeth Gaines sold $9 million of her FMG stock recently so she could get in on the ground floor with the hydrogen production business.
Well, maybe. She's saying it's to pay taxes, which I would probably believe, but she'd have a lot of options. But it's certainly why I think Twiggy's been ramping up the dividends and taking money out of FMG.
I got to say, I know nothing about what it takes to produce green hydrogen, but it's nice to see an Australian mining magnate and an Australian government, for that matter, making a significant investment in making Queensland a world leader in the production of green hydrogen, betting on the future of energy production, not on the rapidly slipping away past energy futures.
I don't know if it is rapidly slipping away. I mean, look at the price of oil and coal at the moment.
Yeah, they're at the moment going up, but come on, we all know that there's the writing on the wall for those things. It's just a question of when, not if.
That's a prediction, is it?
Well, it is, and I got that straight from Steve Sammartino, who apparently, when he was on episode 5, season 1 of our podcast, according to Brett Fisher, who's just gone back and re-listened to it, and this would have been early 2019, Steve apparently predicted a pandemic which would shut down the global economy and force everyone to work from home. I haven't gone back to listen to it, but that's what Brett said on Facebook. So I pinged Steve Sammartino and said, mate, you really are a futurist. Wow, I'm super impressed.
He didn't answer your ping before you pinged it.
Yeah.
He predicted the ping.
Yeah, he said, hey, thanks. And what for? For the message you're about to send me. All right, let's talk about Moz, if we can, for a minute. Chart MOZ. I was doing this one 5 o'clock this morning, trying to get the buy list ready to compare to your buy lists. So Mosaic Brands, it was a big collapse here. It started November 19, bottomed out with the COVID cough, but it was falling before that by the looks of it. And then it's been bumping around down the bottom there, trying to get back over $1. It peaked September 2018 at nearly $3.50. And then it's now trading at around 60 cents. When you look at something like this, I know we've talked a bit before recently about looking at shorter term graphs, particularly if companies have had major restructures, etc. For a company like this, how do you treat it? Do you just take this as business as usual? Do we have to drill down into what's going on there, why it fell late 2019?
Yeah, I mean, you do. If it's just fallen off because the business is deteriorating, then it's not worth trying to drill down any further. You take the 5-year graph and just say it's a bad business. But if this is the business I'm thinking of, at some stage in the last 5 years, they divested a company called City Chic, which has just taken off. So potentially, maybe that happened at the time that the share price went down because, the investors got a spin-off. The shares were spun off into something else. But I think the timing was before this, or it's a different company. But anyway, that's what you need to do, is drill down and try and work out whether there's a reason to look at the short-term performance or not.
And do you bother? Like, you've obviously had a look at Moz because it came up on my list. When do you bother to do that? When do you not bother to do that?
I didn't bother, and the reason why is because I went back and looked at the different time periods. The 3-year time period still looks like maybe it's just getting into a buy using the 3-year. Probably not. Yeah, maybe it is. I'd have to draw the lines. Looking at it quickly and eyeballing it, I'd say it's a sell, and I wouldn't like to use a range much smaller than 3 years. Like if you look at the 1-year chart, yeah, it's a buy on the 1-year chart, but 1 year is only 12 data points, so there's a fair bit of noise in the 1-year chart. So if I looked at the 3-year chart in Stock Doctor and it looked like it was compelling, I'd probably drill down further, but it doesn't look like it to me. It looks like a sort of just the same sort of pattern as the 5-year chart, really.
Yeah, but then I'm starting with an H1 probably September 19, I think. It would probably be my H1 if I'm taking a 3-year chart. My H2 would be January 21. Could probably go a little bit later if I could go April, but still it's going to be a buy maybe, or maybe it's got to sell after that, right? It's still got to sell.
Yeah, look at the sell. I think the sell would
May,
be
June.
L1 March 2020, and then L2 would have originally been September 2020, so the sell would have occurred around May. So the L2's dropped a little bit, so it's probably above its current sell line, but then the buy line, the buy line's probably just crossed this month, September 21. It's a little bit above, but it's not like it's going sideways and it's not compelling, really.
No soup for you then, for Moz?
I wouldn't necessarily go any further. I'm not saying that you couldn't go further and work out a reason why the shares dropped late 2019, and in which case it probably is just slightly a buy at the moment, so you might want to look at investing in it, but I haven't done the research to know if that's true or not.
Right. Well, I was just wondering this morning because how much time should I spend on this? How much work should I do in it?
For me, if the graph was going up sharply at the right there, I'd do the work, but it's kind of just in buy territory, perhaps, at the moment.
Right. Nothing to see here.
Yeah, that's what I think.
I want to talk a little bit about our portfolio, Tony. Like, we were looking like chumps there a couple of weeks ago after the iron ore collapsed, and we were below the SPDR 200 for the financial year. Last week we're up 3%. This week we're up nearly 6%. With the 200 up 0.5%.
For the financial
year, yeah. So right now we look like complete legends and champions. For a couple of weeks there, we look like complete chumps. So there you go. The difference that a couple of weeks can make.
We never look like complete chumps. Come on. Life's all about timing.
Timing. Yes.
Yeah. Good time to up the advertising spend this week, Cam.
So, yeah, it's looking good again. It's not as good as it looked like going back at the end of July when we were up 10%. But we were up 10% and the 200 was up 2%. So we were doing roughly 5 times better than it then. We're doing roughly 10 times better than it now. So I guess we're doing better now than we were then, relatively speaking.
Relatively speaking, yeah. But again, it's a short-term data set. There's a lot of noise in there.
You decided this morning that we had to sell MTO because it's breached its sell line.
Yes.
But what are we going to replace it with?
What did I say? We sent it through.
Did you?
Our stock of the week.
Oh, I didn't see that.
It's CLX.
We're going to replace it with CLX. CTI Logistics, is that what that is?
Correct. That's the one, yeah.
Okay, and you're going to do a pulled pork on that, I think, today.
I am, yeah.
Before we get into that, though, I also want to talk about our stock tips, the stock of the week tips that we've been doing officially again since early September. They were all under water a week or so ago. Now, not so much. Looking pretty good, actually. A couple are still down. AIS is down 11%. IGL's down 9%. Maya's down 15%. It hasn't recovered from Jeff Wilson's sell-off. Thanks a lot, Jeff. We know you listen, Jeff. Everything else is doing okay, or at least hasn't moved at all. CGF is at 0. KRM's at 0 since we bought it. Everything else is a little bit up, though, so it doesn't look too bad. 70%.
Yeah, I think we're kind of back to square. I mean, this is, again, small sample sizes. I think once we get up to, like, tracking sort of 15 to 20 recommendations, we might see it behave more like a portfolio rather than just be, the vagaries of individual stocks shooting one way or the other.
Yeah. Of course, we only ever claim that we're going to get 60% of our balls will fly right.
Correct.
But too soon to be talking about balls flying right, I have to say, because I'm still walking a little bit funny this week. Still a little bit tender. We don't need to talk any more about that. All right. What do you want to talk about today, Tony? Musing on this rule to replace 3 PTLs. What?
Yes. Nowhere near ready to recommend it or to use it. But I guess what triggered my thinking was that I often talk about using 3 PTLs and getting the first 20% of a downturn, which tends to happen, right? We're waiting for a trend to establish itself. So then I thought, well, why don't we use 20% and try and see if we can fit that into graphs, and started looking at some. This doesn't work for every situation, and there's got to be a lot more work done either by myself or by Dylan or someone like that to analyze it. But if you just look at any particular stock graph, I've got Mosaic Brands open at the moment, so that's as good as any, I guess, if I have a look at it. Let's look at the 5-year. That's a longer term trend. I think H1's still going to be September 2019. H2 looks like it's November 2019, and you draw a line through those. What I'm suggesting...
Why isn't H1 back in September 18?
Oh, is it? Okay, let me just have a look.
Can't be 8% from
349 versus... Yeah, probably is actually, you're right. September 2018, H2...
It's September 19.
February 19?
They would have had a sell about June 19, so we need an H2 after June.
Okay, so then we're using September 19 as the H2. Yeah, anyway, so my point is that if we take the H2 and look at a 20% decrease in that share price, so H2 on this case is 294, so it's going to be, 58 cents below that. It's going to be mid sort of 250s, 260s. It becomes a sell on that way down, right, off the cliff. So it's going to be a sell probably in November 2019 or maybe December 2019, which is a good time to sell. And then if you look at the L1, L2 currently, so L1's going to be March 2020, L2's probably going to be August 2021. If you look at the price 20% above L2, L2's currently at 45.5 cents. So again, 9 cents above that, so 54, that's 20% above, 54, 55. It's probably a buy right now, almost a buy right now. Yeah, current price is 60 cents, so it's a buy right now because it's trending up. So this has kind of just been a rough approximation of an idea, so I'm just going to start doing some research on it. If I can flesh out some rules that work in every sort of circumstance, which this kind of does cover most bases. It doesn't always pick never picks the cross of a buy line or a sell line, but it gets us in and out in the same sort of general area. That's going to be a lot easier to code because we can just simply take like the 5-year monthly points, work out H1, H2, L1, L2, and then apply 20% decrease or increase on those and get our buy and sell.
When does the border open up with Victoria?
When does the border open up? They haven't announced it. I'm hoping before Christmas.
I think, Brett Fisher will be hunting you down if you just get rid of the 3 PTL and say, we're just going to do 20%, 30% above L2. We don't need that. He's spent 6 months of his life coding this bloody thing. You're like, I
haven't done enough research yet to prove this. It's just amusing.
Yeah, you better go into witness protection, man, if you change that. Brett will be hunting you down. In your email to me, you said buy when it's 30% greater than L2, but just now you said 20%.
Did I? Yeah, it's 20. Sorry, that must be a typo.
Right.
20.
Wow.
Yeah.
So you're going to do some regression testing on this at some point and see what it looks like.
Yeah, I mean, I haven't quite worked out how to do it yet. And if we get an analyst and get into the Refinitiv data, we'll do it that way. But yeah, I've got at least 2 years worth of buy list now. I can go back and check that against the 3 PTLs anyway. Or just pick a sample, see if it's worth progressing.
How did you cook up this little idea?
Yeah, well, like I said, listening to myself talk about 3 PTLs and when you're buying in and buying out and the questions that we get, we often miss the first 20% of an upturn while the trend establishes itself. And we eat the first 20% of a downturn while the trend establishes itself. You know, if you think Fortescue Metals Group, the high price was about $25. We got out around 20. That's kind of 20% below the peak. I keep saying it enough to myself or to you or to other people who listen. Is that actually the basis for a rule? And I then looked at the graph and thought, yeah, it actually fits L2 and H2.
If it rises 20% above the L2, we just saying, okay, we think there's a trend now. That's it.
Well, that's the hypothesis,
Yeah.
Yeah.
Very cool. Sorry, Brett. Back to the drawing board, Brett.
Well, no, we'll keep using 3-point trend lines and Brett's fantastic calculator, which is such a great time-saving device.
Yeah.
We'll just do what we always do. We will challenge it. He's the champion. We have to challenge it and see if we can do that.
Right. GCY is back on the buy list, Tony. I spotted that this morning.
Yep.
Gascoigne?
So, Gascoigne, it's a oil and gas company. Did a bit of research into it. 2 things. It's under a takeover offer, which is potentially why it's back above its buy price. And it went into a trading halt today, which I noticed when I was preparing for the show. So we can't buy it today, so we'll see what happens. It was last time it traded on the weekend when I had a look, it was below the offer and the directors were saying take no action, but obviously something's happened in between, so we'll see what happens today.
And remind us what Gascoigne do.
Oil and Gas Explorer, but I'll just look it up in Stock Doctor and get my answer spot on.
And oil is continuing to go well. Gold exploration and development, according to Stock Doctor.
Oh, got it wrong, have I? Sorry.
Yeah.
I thought it was a oil company. No, you're right. It's a gold mining company. My mistake.
Same thing. Oil, gold, you know.
Black gold and gold.
Yeah, gold is still doing well. Who's making the offer? I'm downloading their statement. Doesn't say.
Westgold from memory. Another gold company.
Westgold, right. So this might be one of those cases where we're not the only ones who think it's undervalued.
Correct. Exactly. Yeah, Westgold do, obviously. And potentially more. It's the first bid. So, the first shot's never the last shot in the war. I'd expect it to be higher bids.
Right.
Or Gascoigne does something left field and does a Logan Roy and tries to take over a big company and a shitload of debt as a defence strategy.
You're still watching Succession, I see.
I finished.
Good stuff, isn't it?
Yeah.
Good show.
Loved
Good
it.
show.
Yeah.
Kind of crazy. Good to know. I don't own it, so out in the cold here. I wish I did, by the sounds of it.
Well, you still might be able to. I mean, it was trading below its bid price on the weekend, which is why I put it on the list to talk about. And who knows what comes out of the trading halt. We'll see. I suspect another bid, but we'll see.
CTP is back on our list. Who is CTP?
This was the Oil and Gas Explorer. Central Petroleum. Right. There you go. I knew we had one somewhere.
CTP, baby, you know me.
Yeah, it just might be of interest to people. It's down 4% today, so I'll warn people on that.
They're not oil either. They're gas, an onshore gas producer.
Yeah, well, gas, good point. They often go hand in hand.
Supply oil and gas from their Mereenie, Palm Valley and Dingo fields. So that's right, oil and gas. Okay.
They usually go hand in hand.
You said that last week, right? It's like the gas and the oil.
Oftentimes, oil contracts and gas contracts are written at parity to the oil price. They often go in lockstep, but generally if you're drilling for oil, you'll find gas as well.
ADT of about 33,000, these guys, so they're sort of good for the bigger end.
They're small. No, 33,000.
Yeah, it's big for me. Indoor skydiving, they have a qualified audit.
Yeah, man, and this is I guess this is topical given that I've asked Steve Mabb from the ASA to take a look at Appendix 4Es for me. And while doing prep for a submission on that, I looked at the ASX rules, and one of the Appendix 4E questions is, A, are your financials audited? B, in that audit process, was there a material concern or a qualified audit? And C, if your financials aren't audited, do you expect when they are audited that they will contain some kind of qualification? So in the space of 30 days, Indoor Skydiving put out their Appendix 4E and said, no, the financials haven't been audited yet. That's it. 30 days later, report comes out, qualified audit. material concern over the going concern, right? So we'll give IDT a pass and that maybe they didn't know, but really.
IDZ, I think it is.
IDZ, is it?
Z.
Sorry, they call it IDT. IDT is a different company. Indoor skydiving anyway. I'll give them a pass because I've got no reason to say they didn't know. But I mean, the ASX should at least look at it. You're 30 days away from an audit being handed down and you didn't know that the auditors were looking at whether you could continue trading.
Yeah, right.
They hadn't discussed it with you, right? So anyway, I don't want to skate on thin ice in terms of, falling foul of some kind of libel lawyer, but please give me a break. Come on, ASX, have a look. Indoor skydiving.
Very strange.
And just another example of, just the strange things that go on with these Appendix 4Es. I shouldn't just single out indoor skydiving. There are other companies that either don't answer the question full stop or answer it with remarks like, check our annual report for our audit, which is not the answer that the ASX is wanting. It's quite clear what you have to answer. Yes, no, maybe are the answers to the questions, and it just gets ignored so often, which means you have to go through the annual reports and, just adds time to your analysis. And on top of that, Alex and I will, as an example about how to find a qualified audit, I was showing her, I thought, I'll pick a big company and show her how to find an audit statement in a big company. So I picked like the biggest or one of the biggest, BHP. In fact, she asked me, she said, how do I find audit statement in BHP's annual report? It took us like 20 minutes to find it. Seriously, members who are listening to this, go and look up BHP's announcements. You'll find something like 600 pages of stuff they've announced. And the audit report is not near the end. It's buried away in the middle. It's not even in the contents to the reports, to the filings. You got, the US filings, the UK filings, the Australian filings, and the Australian filings kind of rolls up some of the other ones. It's like hundreds of pages long. The annual report doesn't appear in the index or the table of contents. Sorry, not the annual report, the auditor statement. And so you have to go digging for it. It's just seriously, it's probably the most important thing, any annual report, is what does the objective auditor, the eye of Sauron, think about the landscape for BHP, right?
Yeah.
It's the first thing an investor should look at.
Yeah, but BHP is not going to have an audit problem, surely.
No, and we'd read about them on the front page of the Fin Review if we did. By the time it took, Rear Window to go through and comb through 600 pages of text to try and find the audit report without an index. Yeah. But yeah, no, you're right. If BHP can get away with this kind of obfuscation, how can the ASX beat up on a small company?
But getting back to the tendency some of these companies have to not be clear about it in their 4Es, what do you think's going on? It seems like a pretty simple thing to do. Just state clearly what the position is with your audit. Why would they say things like refer to our annual report?
I suspect, and I think I'd be the same, and if I was in the company secretary's shoes, I think they see it as bureaucracy, right? They've filed the annual report, they filed it with the auditor's statement. Why do they have to also do an Appendix 4E filing?
But they're doing an Appendix 4E anyway.
It's a listing rule.
Yeah, when I've seen these Appendix 4Es and I've seen the audit statement, it's a couple of lines anyway. It's an onerous thing that they have to do. What's the big deal?
I just think it's been let slide for a long time by the ASX. They haven't pulled anybody up, haven't made an example of anyone.
Right.
And I think it's because, people don't... Yeah, it's law of large numbers. There's half a dozen companies on our watch list that have qualified audits. Maybe there's only a dozen companies that are on the ASX that have a qualified audit. So most times it's completely irrelevant. But it's so important on the times when it's not that they need to put their returns in properly.
Okay. Mixed commodity miners. I was looking at MIN this morning, actually, trying to work out how to think about commodities for somebody like MIN.
Yeah. So when we talked about AIS in particular, I gave it a pass because it's a mixed commodity miner. And even though it's sells iron ore, which has gone down in value, at the time I wasn't sure whether that was good enough for it to be a sell based on a commodity sell situation. But I think it probably is now. If you look at MIN, the first thing I go to try and work out what the ratio of the different commodities is to go down to, I'm in Stock Doctor, go down to the earnings breakdown section, which is kind of almost at the bottom of the right-hand part of the front page in Stock Doctor. And oftentimes it gives you an earnings breakdown by the product it's selling, but in this case it doesn't always. This time it's giving it to us by division, which is just listed as central commodities and mining services. And you can see from the breakdown that commodities is by far the biggest part of revenue and profit. So we can't tell the breakup of commodities that simply. So we don't have to go to, again, the annual report, or sometimes I go to an announcement, which is the company talking about its financial numbers, presentation to analysts on their financial numbers. And generally you'll find it there, either in the annual report or in the presentation, which will say, here's how each of our commodities are going. But the bigger question is, once you know that, if we know that there's a sizable part of min is coming from iron ore, but not all of it, because it also, I think from memory, has lithium, that, whether we should make it a sell or not. But you can see on the share price, certainly the market factored into the share price, the decline in the iron ore price. It was a mistake, but I didn't have experience in this area. But I think going forward, I'm going to make these commodity sales if a large enough portion, and what's a large enough portion, maybe 30% or more, comes from a commodity that's a 3-point sell.
I'm going through their FY21 investor presentation, trying to find a breakdown, iron ore versus lithium in their revenues. Haven't found it yet. Page 33 of their investor presentation is a pie graph, revenue by end user, and iron ore is 75%, lithium is maybe 20%. 15%, gold, construction and other is what makes up the balance,
Right. Well, this is saying mining services, which is another part of their business. So it's like the contracting part of their business. So we need the commodities part of their business. So you'd expect that they were contracting to iron ore miners and the contracting tap might turn off when the price is low, but that will be less than the effect of the iron ore export section of their business. A couple of pages to that. So I'm on page 35. It's the commodity segments of mineral resources.
Yeah.
And you can see that 1.5 billion out of 1.68 billion is iron ore sales. I should have called this as a 3-point trendline sell. Even though commodities is not their total business, they have that mining services section as well. But it's a lot.
And they also produce spodumene.
I think that's the underlying lithium mineral.
Spodumene is a pyroxene. Spodumene is a pyroxene mineral consisting of lithium aluminium in oscillate and is a source of lithium. We need to do a little bit of work with these mixed miners and figure out exactly what their exposure is.
So I think the upshot is I should have taken both MIN and AIS off our buy list because of iron ore declines. I think AIS from memory wasn't as quite as skewed to iron ore as mineral is, but we should take them off.
Okay.
Someone pointed out that AIS had iron ore in it when I was removing FMG and BHP and Rio from our buy list.
Let's talk about MMS back on the buy list.
So Macmillan Shakespeare, it's a company I kind of watch, and I guess when you've done this for as long as I have, there are companies which continually come on and off the buy list. Not necessarily quickly, but they come and go. And Macmillan Shakespeare and Credit Corp for a long time were a cornerstone of my investing portfolio over the years. Macmillan, and I guess Credit Corp will again soon become too expensive to be on the buy list. But they do pop in and pop out. They've always been good investments for me. Fortescue Metals is similar over the years. So anyway, that's why I kind of went, Macmillan Shakespeare's back on the buy list. It's worth having a look if people want to have a look. It's not at the top of the buy list. It's got a QAV score of, it's 0.13. But it's got a very largish annual daily traded for people who are interested in such things. The company, without doing a full pulled pork, it's a company which packages up or salary packages. So, it handles the paperwork for HR departments if you want to take out a lease as part of your remuneration package, or, there are other things in there they pay for your golf club membership or whatever. It handles all the paperwork for that. It did fall foul of the federal government when Kevin Rudd was in power, and Wayne Swan, the world's greatest treasurer at the time, decided to do something funny with fringe benefits tax around salary sacrifice and change the rules. And Macmillan Shakespeare took a nosedive in terms of its share price as people thought that salary packaging was dead. But then, funnily enough, the government reversed its decision, and then salary packaging came back again the way it had been. Lasted about 2 weeks, I think, before they backtracked from lots of pressure, I imagine. So that's what it does. It's one of those just bread and butter companies. That's all it does. Been doing it for years. Probably has a large market share. I don't want to do a full pulled pork on it, but good to see it back on the buy list if people are interested in adding something that's got a large ADT to their portfolio.
Does well on the founder owner score too, I think, because William Shakespeare still owns a chunk of stock. in that. He's still around.
And with Harold McMillan.
Harold McMillan, yeah, the two of them teamed up.
Yeah.
You want to do your pulled pork for the week? Our stocks of the week, by the way, our large cap is EHL. You did a pulled pork on them a few weeks ago. So I think you're going to talk about CLX today.
I am, yeah. And just an interesting thing happened about Amico EHL before I leave it. I was, again, deciding what to do the pulled pork on and looking at their announcements, and their CFO has resigned for EHL. But I just did a quick look at it. Looks like it's some kind of stage transition. He's going to hang around for 6 months while they transit to a new replacement. So I don't think it's anything to be worried about in this particular case. Clx Logistics, speaking of owner-founders, the founder still holds nearly 40% of the company, so 35-ish% of the company. So, yeah, very strong owner-founder contingents. I think the board in total hold around 40% of the company. Not a big company. It's only got ADT of $8,000, so that's why it's our small cap pick. And the market cap's only around 80 million, so it's not huge. It's for people who don't know, which they may not know about it, it's a logistics company. I think the interesting thing now is that it's a Perth-based logistics company, and at least the large part of the company is operating with small transport companies and courier companies in Perth. And what's the thing we know about Perth Cam in the last 2 years? No COVID, right? So probably the only transport company in Australia that's got all the uptick from deliveries to home, but none of the downside of having staff on the bench because of COVID. So it's doing well. Sales are up, profits up, and also too, not just the Perth side of it's up, but they do long haul to the eastern states, and that's up too, as just generally parcel deliveries are up because of COVID. So, yeah, it's riding a bit of a wave here, and it's in a good space. Going through its numbers, QAV score 0.36, the quality score is 83%, PE is less than 9, 8.8, price to operating cash flow 2.32. So obviously a value play for us. Another good thing I like about a stock like this, low broker coverage. So we've got no forecast IV, no forecast earnings per shares, anything like that in Stock Doctor. So this is one of the ones that will eventually, I think, come onto the radar of some of the stockbrokers, but at the moment it hasn't. One downside, which is interesting, the financial health has gone down from strong to satisfactory, but it does tend to oscillate between those two metrics. So I'm not overly worried about that. I think it's probably just a 6-month thing for this company. Strong yield, current yield is over 4%, so it scores well for us there. Equity, consistently increasing equity scores is 0 over the last 6 halves. But if you look at the last 4 halves, it's increasing. So it's, even though I'll score it as a 0, it's not overly worrying from that side of things. Net equity per share is $1.18, which is higher than the current share price of 96 cents as of when I looked this morning, the 11th of October. So we're actually buying this for less than its fire sale value, which is always attractive if you're an investor. And it scores a 2 for having a record low PE. So all in all, good investment, I think.
What did you say the price to operating cash flow was again?
Yeah, 2.32.
Very good. All right, CLX. Thank you for that. Have another look at that one. Time to get into the questions for this week, Tony.
Yeah, good.
David says, hi, Tony and Cameron. I enjoy your podcast and may consider joining at some stage.
Well, let's just stop there. I mean, if you're not a member, come on. We know only smart people join up. Because, come on, can I give this guy some airtime, really?
Well, the funny thing is he won't hear this because he hasn't joined up.
Okay, well, read away then. Let's give him another reason to join.
He says, I have a strong leaning...
No, it's a good question.
I thought there were some interesting points that I hadn't thought about before.
There is.
I have a strong leaning against investing in fossil fuel companies. I understand why they may be good stocks to trade, different from investing. I disagree with Tony's reasoning that investing in coal is okay from supply side, i.e. if we don't sell it and there is demand, someone else will. Or our coal is cleaner than other countries, so it's better that we sell it, or it is important for Australian jobs and our economy. Unfortunately, I have to say that none of these reasons satisfy my ethical framework, but I realise that ethics and values are very personal. To me, the environment is so important that every opportunity to make a statement by my actions should be grabbed. Buying coal companies provides a price signal, i.e. more buyers push up the price and value. Public companies raise capital at IPO or share issues. Would you turn down a share purchase plan offer from a coal company you own at a discount, and if not taken, would dilute the value of your shares? Those funds go to the company, not the shareholder who sold them to you. Finally, employees and management are rewarded with shares and options, so increasing the value of shares increases incentives to keep the company operating longer. We need strong action on climate change, including leadership by people like you who have a significant audience. Coal prices might increase in the short term and those companies may be more profitable in the short term, but they are dead assets long term. Finally, Tony, I implore you to use your wealth for the benefit of the world community and for the benefit of your children and their children by producing more of Cameron's documentaries. Oh, well, thank you, Dave. It's nice of you to say that. There are plenty of other investments with good returns. Sorry about the comment about Cameron's documentaries. Still like your podcast, David.
Yeah, well, good. Well, thanks for the question, David. I have to say I generally agree with all of your points, except how they apply to investments. So, yes, I'm very much in agreement with the majority position on climate change. Do whatever I can to reduce my usage of fossil fuels. I pay more and get my clean energy from my electricity supplier. We're in an apartment that doesn't have gas. I drive a car which is meant to take some of the carbon out of its emissions. There's been scandals around that, so who knows, but that was my intent anyway. My challenge, so I agree with David around all those things that we should be doing to reduce the problems for ourselves and for our kids. But my challenge to David is, how does me not throwing a couple of $1 million at New Hope coal shares save the planet? How does it stop any of those things from occurring? It doesn't make a statement because no one would know that I didn't buy the shares. I guess unless I came onto a show and said, hey, I'm not buying coal shares. That's a statement. And I had to smirk when you read out the question because I just haven't thought of myself of having an audience that was, worth making a political point to. But anyway, maybe there's some degree of soapbox that I can stand on to talk to people. And I certainly would say, try and do what you can to stop climate change. But I don't think not buying shares is one of those things. I disagree. I think I do see David's point about making a statement. And obviously if we make enough statements and it sways political pressure, then that will have an effect. But unless you're making a bigger statement would be to buy shares in New Hope Coal and going to the AGM and calling out the board for not doing what something like Twiggy Forrest is doing and investing in renewables or having a plan to move away from coal mining to get into renewables. That's the thing. If we close down all the coal mines tomorrow, we kind of cut off our nose to spite our face. I don't think we're ready for that yet, even if we could do it. So it's a tragedy of the commons issue. I still see this as being a supply side problem. You don't solve tragedy of the commons issues by saying, okay, I'll voluntarily not graze my sheep on the commons because the grass there's dying and not going to be able to regrow in time, because then someone's just elbow you out the way and put their sheep there. It only gets solved when the mayor of town comes in and goes, right, you and you, take your sheep and piss off. Where there's overgrazing going on here. So that's my solution. And I think I'm fully supportive of that happening. But if I can make some money along the way because the coal price is going up, and that's David's point, I guess, is maybe I'm a trader rather than an investor in this kind of situation, that I'll hold it until the commodity turns down. Whether that's next week, next month, next year, next decade, I just don't know. I'm not a predictor of it. But I also, will say, for what it's worth, I don't own shares in coal companies. I do have shares in Santos, which is an oil and gas producer. But again, what do we drive if we say we're not going to allow petrol-fired cars to run on our streets? I think it's, going to be, as probably will happen in the Glasgow Climate Conference, it's going to be a roadmap out, which will take until 2050 to get us to the targets that we need to get to. And some countries will get there in 2030, including maybe China, which will kill most of our fossil fuels industries anyway, or certainly damage them. And we'll just, make those calls as they present themselves as investment decisions for us. But until then, I'm not fazed by buying shares in a coal company. I take David's point that, will I work for a coal company? I don't know. They may be a good enough offer, maybe, but it's a case-by-case decision, I think.
What kind of offer would any company need to make to get you to go work for them now, Tony?
Yeah, 8 to 9 figures, mate.
Well, let's answer some of David's specific questions. Would you turn down a share purchase plan offer from a coal company you owned at a discount, and if not taken, would dilute the value of your shares?
Yeah, good question. I'd have to look at the numbers and see whether it was a good deal or not. So, and we don't know. And I'm assuming what David means is that they're going to use that to buy another mine or another coal company or whatever. If the share purchase plan was to build a hydrogen plant, then yeah, maybe I would. But yeah, it's a case by case. I think what David's trying to do there is negate my argument that I'm not buying shares where the money flows through to the company. I'm buying shares from someone who's selling out of their shares.
But your answer is, well, if they were going to use the money to dig more coal out of the ground, you wouldn't, or you still might?
I'm not going to be categorical. I mean, I'm here to make money in the share market, first of all. With one hand, I can buy shares, and with the other hand, I can lobby my local member of parliament to shut down coal mines. I don't see an incongruity in that.
Oh, his second point, which I thought was interesting, is, well, by buying shares, you are propping up the share price to some degree. The share price is the basis of incentives for the executives. So by buying fossil fuel company shares, you're in fact rewarding fossil fuel company executives indirectly.
Yeah, because I want them to do a good job while I'm an investor. Yes, I am. There's a lot of things at play here. One is, I guess, let's start from the top and work down. Other companies I would feel terrible being an investor in. I think there probably are. For me, it would be tobacco companies and maybe some arms manufacturers.
What's the difference between?
Yeah, exactly. It's personal ethics. I think with a tobacco company, in both cases, potentially, we know they're harming us. I think with the coal company, I think there will be, if there's not already, a plan to move away from fossil fuels. With the tobacco company, I think there's always going to be a rump of the population, which seems to be settling around 10%, who are going to smoke, even if it kills them. That's why I think I would not necessarily favour investing in a coal company. Coal companies kind of fit the sweet spot for me. Like, they're a contrarian investment, right? Because we have to have these kinds of discussions. If they were, from a value point of view, they're a no-brainer, and they're a value investment because of that, because there's people out there are opposing their continuance as a going company, which drives the price down. So, it's a contrarian investment. Will they buy shares in the tobacco company? I don't think so, but that didn't really serve things, because all it meant was that enough investors didn't want to buy their shares and they went private. Now there's no one scrutinising tobacco companies. It's like laissez-faire again. At least when they're listed, people would go along and make protests at their AGMs, and they'd have a soapbox that they could step on to highlight the fact that the bad things that were being done by the company. Now they're private, probably not even resident domiciled in Australia. It's harder to do.
In the Psychopath Epidemic book, I had a chapter about ethics and values, and I remember speaking to variety of leading Australian ethicists and QCs around how do you develop an ethical framework. I wasn't thinking about investing then, just living. And, one of the things that I always come back to is the more I drill down into that, in terms of my behaviour as a consumer, and I think that plays into investing, it's incredibly difficult. If I talk about buying the latest iPhone, a MacBook or whatever it is, I know that these get manufactured in China. I know the staff at Foxconn and places like that work intolerable hours for very low pay compared to what we are used to in terms of working conditions in the West. Am I happy about that? Well, yes and no, but it's complicated. Again, it's these people. China's pulled 850 million people out of poverty, and a large part of that is they're working, manufacturing goods for Western consumers at much lower salaries and much worse working conditions than we would expect, but it's better than poverty, right? So I would like to see them paid more. I would like to see their working conditions improved. Does this mean I'm not going to buy an iPhone, though? Probably not. So, just figuring out where I'm going to draw the line and why I'm drawing the line there. What's my underlying rationale for where I draw the line? Okay, so we say coal. Okay, we can all agree that coal's probably a really bad thing for the environment. Flip side is it's necessary for heating and cooling and lots of running electricity for hospitals and, saving lives these days. I had when I was running my marketing consulting business, I had some clients that were in the mining industry, and, they were very clear about their ethics. It's like, hey, our society runs on coal. You take away coal tomorrow and society shuts down. There isn't enough electricity that can be generated today by green energy. So right now it's critical.
That's part of the issue, Cam. I think we will get to a stage where we'll move away from coal, but it's got to be a planned exit to keep everything running. I mean, I used to run the research department at a company, and researchers solve these kinds of dilemmas by conjoint analysis, right? Going back to your iPhone example, the research question would be, would you like to buy the new iPhone Pro at $1,300 a pop and know that it was built by Foxconn, which pays slave labour wages? Or would you buy an iPhone that was put together by people in Australia being paid unionised wages, but it costs 5 times as much, $5,500? Which iPhone are you going to buy? And it's the same with coal. Do you support shutting down coal mines? Yes. Do you support shutting them down tomorrow with no alternative source of power, or even if there is, with no infrastructure set up to support it yet? No. So, yeah, you got to look at these things as a conjoint.
While they continue to exist, should we invest in them or not if they're the best investment in the marketplace?
Yeah, and so I fall on the camp of yes. Happy for the government to shut them down, happy for the government to have a plan to move away from them. But at the moment, they're actually providing a vital asset for most of the world. And I guess we keep talking about thermal coal, but there's also coking coal. If you shut that down, there's no iron ore smelters, there's no steel, so there's no construction, so there's no new schools or hospitals or buildings. It's a simple solution to say don't buy coal shares, but I think it can exist with a more complex solution, which is let's plan our way out of this and we can still make a bit of money on the way.
Well, that was my point in the book, is when I started trying to write my own ethical framework. And I think it's important that we all do this. And I don't think we do it enough. I don't think it's talked about enough. I don't think it's taught to us as children enough to write your own ethical framework. And if you don't have one, it's easy to slide unknowingly into doing all sorts of horrible shit, particularly if you work for the Australian CEO of Sony, apparently. For the last 30-odd years, whatever his name was. But when you start doing that for yourself and you start asking yourself the 5 levels of why questions, well, why do I believe this is bad? And how do I know that to be true? And when you start getting into the nitty-gritties of it, it's actually incredibly difficult. And say, okay, well, if coal is bad, why is an investment in, agricultural companies not bad when
it is
cattle and they're giving off methane and all of this land where we could grow trees that could be pulling carbon out of the atmosphere. Instead, we're producing methane. So now we can't invest in farming businesses either. So what happens to all of Australia's farmers and our food supply? And, the more you drill down into it and try and be consistent, it gets incredibly difficult. It's not
absolutely
simplistic,
And I'm not saying we should abrogate our responsibility for someone to come along over the top and solve those for us. We should solve them ourselves and certainly, vote for people who have solutions for these problems, but you just can't solve it overnight. And not investing in coal companies only spites me. It doesn't affect the coal company at all or save climate change at all.
Yeah. Okay. Thank you for your question, David. If you ever get around to listening to this, I hope you like your answer. Reg! My mate Reg, Brisbane Reg from the ASA. He said, hi team, on this week's podcast there was some chat about other parameters or filters that might be useful. I wonder if Tony or any other members consider a stock's price relative to its 25-day moving average when analysing a buy. I used to buy my data from Investor Centre before I joined Stock Doctor, and their founder, a pretty wily investor, always said, never buy a stock if it is trading below its 25 DMA. Unfortunately, this is not a factor that can be built into Stock Doctor as a fundamental filter, which complicates things, I know. But the gurus there have programmed it for me as a technical filter, as they call it, which can be overlaid on a Stock Doctor watch list. I haven't played much with it yet, but I intend to. Any thoughts? Tony, what do you think about 25 DMAs?
Yeah, well, it's what I'm thinking of. It's like it's the moving average for the last 25 days, which I think Reg said in his question there. It sounds to me like a Josephine, Cam. We've been talking about our definitions for a Josephine, so perhaps the 25 moving day average is a good one to look at, because we've been using as the current price below the end of month from the prior month. 3 weeks into it, and that tends to have more value as you go into the month, the further on into the month you are. And so obviously 25 days in is a more valuable test than the first day of the month. So yeah, I think it's worthwhile looking at. This might be our Josephine proxy, but I'm not familiar with it. Haven't done any research. I can look at it though. But yeah, it'd be interesting to get some more from Reg on his. If he's done any research on using it, is it better to use it or not use it? Is 25 days a magic number? Is it better than 30 or 50 or 10? I mean, they're all the things that we need to answer before we can sort of go out on a limb and say it works.
Well, that was going to be my next question to you. Any idea why it's 25 days? Why is that the magic number?
Don't know.
Okay. Thanks, Reg. Something to add to our list for the team of research analysts that we have quietly working away deep inside of a coal mine to back test all this stuff. Inside of Foxconn, a coal mine in Foxconn. Gary asks, can you please run through the timing for 3PTL cells again? For example, I held WAF for a little while. I think that's West African Resources from memory.
Yep.
Had the bad news about the coup in that area and broke through the 3PTL during the month and now has recovered significantly and doesn't show being below the sell line at all. Yeah, I looked at the chart for that this morning and it's had a huge spike.
I don't think I own WAF, so full disclosure. I don't think it broke through its 3PTL though. But what it did do was it came very close to being a Rule 1 for me. And I think from memory, the share price around the time that we talked about it, or at least we put it on the buy list, was around 90 cents, and it got back to around that in the last couple of weeks, and it's shot back up from there.
$1.26 it is today. When you're saying it didn't break through the 3PTL, you mean it didn't break through its sell line?
Correct, yeah.
Yeah.
Have a look at it. It's got a really low sell line. I've just called up in the Bretta later.
Yeah, I've got it now. It's about 66 cents,
yeah.
I think. Yeah, it dropped down to about 75 back in March of this year, but is way back up since then.
I think we might have talked about it after that, or I think I might have bought mine after that. I'm pretty sure I paid 91 cents for it, something like that.
Yeah, I did see. It wasn't that long ago you talked about the coup. I'm just a quick search. It was episode 438. Oh, the same episode you did EHL as your pulled pork, by the way. But yeah, Mark had asked why it was dropping, and you said there was a coup in Guinea. This is back in just the 28th of September, only a couple of weeks ago.
Yeah, but what I'm saying is I bought it before then, and it dropped back to close to my buy price. I may have bought it for like 98 cents, and it dropped, 10% below that was 90 cents. But I remember I was focusing on 90 cents as the sell price for me.
Right.
But either way, still way above its 3-point trend line sell price.
Yeah. So Gary's question was about the timing of 3PTL cells. I'm not really sure what he means, but the sell it breaches the line you sell, right?
Yeah, I mean, there's a couple of things I've got a couple of stocks at the moment that breach their sell lines, and I'm kind of hanging on just for a bit longer because it's a bit like the CBA experience. It breaches it, goes ex-dividend, it breaches, we add a dividend back, it comes back up, the dividend gets paid, and it's still below its buy line, but it's still going up. So yeah, look, when we're down to sort of cents, it's like a couple of cents below its sell price. It looks like it might be trending up. I'm going to hold and see if it recrosses. If it drops again, I'll sell. Yeah, but
right.
So yeah, it's a little bit of finesse going on there. But if it was like dropping fast and had rocketed past its sell line, definitely sell straight away. But I tend to linger when it's like a cent below or it's just gone ex-dividend, and you can make sort of a case for it. Once it settles down, you'll turn around again. But generally, we just go rules as rules, and if it drops below, we sell. Yeah,
unless you don't. Yeah. unless you want to fudge it a little bit. Hold on to it for a bit. Okay, I hope that helps, Gary. Scott asks for you to give a dissertation on Elliott wave theory, and follow that up. Second point to that question is, can you explain quantum wave theory at the same time?
Yeah, sure.
What's Elliott wave theory, Tony?
Yeah, so this is a part of technical analysis, so it goes way back to like the 1930s, and it talks about, it's sometimes called the triple peak or triple head. Sometimes it's called head and shoulders. There's always different names for it. But basically it looks for a series of, I think from memory, it's 5 peaks on the way up and then 3 peaks on the way down, and uses those as buy and sell signals. So like I think it's a sell signal after it has 5 peaks in a row, and it's a buy signal after it has 3 peaks on the way down. So successive peaks are lower for 3 times. It's a buy signal. I looked into it like about at least a dozen years ago, as I looked into a lot of other technical analysis things after the GFC, trying to find out a way if I could, improve my returns in a dropping market. And I settled on the 3-point trend line algorithm, which is much simpler and seemed to work for me. I couldn't find a reason for Elliott wave to work, and it didn't work when I looked into it for myself. I picked out a sample of stocks and tried to trade them with the Elliott wave, and it didn't work. I did go into what's it called? Investopedia today, on investment terms anyway, and they agree with me. They explain what it was, but there was a quote here saying, not all traders interpret the theory the same way or agree it is a successful trading strategy. And I think that's probably the Elliott wave theory in a nutshell. There are like rules and sub-rules and sub-rules of sub-rules about when to apply it, when not to apply it, and it's pretty subjective.
Now explain Heisenberg's uncertainty principle.
If you have a cat and you put it in a box, you close the box. Heisenberg uncertainty principle is act of measuring something will influence the thing you're trying to measure, so you can never really measure something. See, I did university physics, Cam. Yeah. Yeah,
well, there goes the 3-point trend line. We can't measure anything. What's the point?
Yeah, true. Yeah.
It only goes up because price only goes up because you're looking at it.
Well, actually, that's probably true. There's probably something in that. If enough people are looking at the price, there's probably enough people buying it and the price goes up.
There you go.
Yeah. But no, I wouldn't recommend any of these technical analysis things. They promise the world and, just like we are with the 3-point trend lines, you can spend a lot of time trying to finesse it and nail it down, but they work more in the general than they do in the specific sometimes.
You ever hear Buffett talk about any of this technical analysis stuff?
Ooh, good question. I haven't, no. I'm pretty sure he wouldn't be a user of them though. I can't think of any quick quote. I mean, I say things like, the only person who makes money out of graphs is a map maker. So, yeah.
Did you see the cartoon I posted on Facebook today?
I did. You see my reply?
No. What was your reply?
The cartoon was.
Oh, I did.
Someone was asking a value investor about whether they should use bleach on their undergarments.
It was a wife in the laundry doing the laundry, and her husband's reading a book on Warren Buffett. She goes, "Oh yes, please tell me what Buffett has to say about using bleach on your delicates." And you said,
I said Buffett would do a discounted cash flow on the cost of bleach, and then work out it was better investing in Berkshire Hathaway.
And then you said,
"And why would you have to bleach your undergarments anyway?"
And I replied, "You've obviously never seen." I said, "You've obviously never seen my undergarments." That's. But that's what I thought it was good because that's what it must be like being married to a value investor. Well, according to Warren Buffett.
Yeah. Well, I think it was in the Making of an American Capitalist that his wife wanted to replace the curtains in their home, and Buffett wouldn't let her because he did the DCF on what the curtains are actually worth if you took it out long enough into the future with the money invested in Berkshire Hathaway. From
memory, it was going to cost $10,000, and he worked out what he could do with that $10,000 over 20 years, what he could turn it into.
Yeah.
And so she divorced him. And so there you go. That's the moral of that story. 30 years later, but still.
Yeah.
Thank you, Scott. Tony. Trent asks, Tony's view on letting emotions impact an investing decision and a review of ATL's price with a reaction from Cam. Thanks, Trent.
Well, have a look at ATL. It's nearly doubled in value since it came back on the buy list and got taken off, even though it doesn't have a qualified audit, but I was concerned it was raised as a key audit item that the company may face problems if COVID keeps going. So, yeah, what do we do, Cam? Do we put it back on the buy list now as the the market proved us wrong that ATL actually is a good investment?
One of our subscribers, I can't remember who it was, but somebody sent me an email the other day saying that ATL was the best performer in their portfolio. And I said, good luck. Let me know how that works out for you.
Well, it's got a QAV of 0.46. I looked it up this morning and I saw the question.
Wow.
And its share price has rocketed since we talked about it and didn't buy it. So it's the reverse. We've got the reverse curse. We're not buying things and they go up when we talk about them. If we had have done a pulled pork or bought it, it would have gone down for sure.
Yeah. Back at the end of August, it was trading at 38 cents. It's currently trading at 72 cents. It's doubled in a little over a month. Oh, my God.
Yeah.
There you go. Look, and as I said on Facebook when somebody was ribbing me about ATL recently, I will never, ever, ever buy Apollo Tourism and Leisure again unless you tell me to, and then unless it has a good score.
I'm tempted to take the qualified order off it and put it back onto the buy list.
It's too late now. It's already up 100%. I guess it could keep going, but
I'll stick with my original plan. I'll wait till the half and we see some new numbers and make sure it gets through COVID.
It was up as high as $1.85 back in January 2018, but it's been a long time since it's been up in those areas. No, but look, all joking aside, if it came up on my buy list and we were quite happy it didn't have a qualified audit or any taint around that had been removed, sure, I'd buy it. You know, numbers are numbers. Rules is rules.
Correct. Yeah.
It's burned us a few times in the past, but I don't hold grudges. If people know anything about me, it's apart from the fact that I'm insanely good looking, it's that I don't hold grudges.
Really?
Okay, I was joking about the good looking bit, but the grudges thing, okay, there's a few people I would happily push into a wood chipper. But apart from that, that happened to a cousin of mine. But anyway.
Yeah, I know you said that. That's terrible. Yeah, so look, I'll stick with the original plan, which is to see what happens next half with ATL. But yeah, good luck to the people who took a risk.
Yeah.
That's often the way it works. You big risk, big reward.
And also big failures if you get it wrong, but, live on the edge. All right, this is the last question. This came in via email from Sue today. Did you see this email from Sue?
No.
Okay.
Go ahead, shoot.
Easy for you. Anyway, she says, hello, Cam. Continue to love the show. I'm assuming it's not my first wife, Sue. If it is, hi. How you doing? It's been a long time. I've also started listening to your Cold War podcast, which I'm enjoying. Then I think I noticed that she had some sort of Catholic.edu thing in her email address, and I was like, oh, Sue, I'm not sure Catholics should be listening to my Cold War show because it gets pretty nasty, but good luck with that. Anyway, she asks a question for the QAV show. With the ever narrative of inflation fears, what is Tony's take or explanation or experience with investing in QAV theory? I'm still learning, but with inflation, if goods and services prices increase, won't the value of shares, business, property, and assets also increase? Thanks again. Love the shows. Cheerio, Sue.
All right, I can't see the question. Did Sue say would business values decrease if inflation increased?
No, increase. If goods and services prices increase, won't the value of shares, business, property, and assets?
Well, potentially. Inflation is generally seen as being a bad thing for markets because the borrowing cost for business goes up. That's probably the main driver. And unless wages keep pace with inflation, then people can afford to buy less. So that's generally inflation seen as an anchor on the economy. But, as we said last week with a similar question, we don't care. It's we'll find stocks which will profit during inflationary periods. I don't know what they are now. They'll present themselves at the time. And we'll invest in those. Even if the market's going down, we'll probably still find some stocks to invest in. So, yeah, I'll be led by what's in front of me at the time rather than trying to make a prediction. But, yeah, I have spoken about inflation in the past. I think it is at some stage in the future going to be a headwind for the share market generally. I think, those kinds of things play out with a move in bonds in the US, which affects the share market because, the borrowing costs are priced on bond prices, bond yields. And America will suddenly have a hissy fit and the share market will drop 10% in a day, and then we'll wake up in the morning going, oh shit, really? Don't know what's going on, but I better sell. So the hysteria takes over and our market's then down 15% suddenly. And, I've seen the whole thing play out like that before. But we'll just keep doing our thing, which is, our individual stocks go below their sell prices, we'll sell them. And if they don't, we'll hold them. And if we find ones which aren't affected by inflation, and maybe Sue's alluding to some of those, then we'll buy them. Usually inflation works well for commodity stocks, so it's a bit of a chicken and egg thing, but, if we start to see inflation, we normally see iron ore, copper and stocks like that go up in value as well. Sometimes an increase in commodity prices drives inflation, and sometimes the underlying inflation drives commodity prices. So, for example, gold will generally go up if inflation's there because people want an asset to protect the value of their cash or their cash equivalent, so they'll buy gold as a store of value. Some of that rubs off onto some of the other commodities. So there'll be businesses out there which will be benefiting from inflation for sure.
And if we wake up that morning and the market's down 10 or 15% and we have to sell 2/3 of our portfolio, we then just replace them with stocks that we've decided to looking good and are undervalued and wait for the market to ride back up again.
Yeah, I mean, the worst case is it goes down to 10, 15% on one day and back up the next day, as it kind of did during the COVID cough. But even in the COVID cough, we were able to profit from it. So, it gives us a cash portfolio to deploy when and if we find something better to deploy it to.
Yeah. And you've said before, like the COVID turnaround was remarkably quick for a variety of reasons, but sometimes it's not that quick. Sometimes it can take a year for the market to bounce back, but our job is to find the stocks that are undervalued and get in on them and wait for them to revert to the mean.
Yeah, I think there's kind of two things to consider in terms of market corrections. One is the black swan event, right? Like it's you don't know what's going to hit you, and when it does, everyone goes, oh yeah, I should have seen that, and the market's down 20, 30%, right? And you put the GFC in that category. Sometimes it comes with a bubble, so you can put the tech wreck in that category. People knew it was coming, but when and if, who knew? And then you got the other ones, which are more sort of just run-of-the-mill downturns, I'll call them. And I think inflation might fall into that camp. I remember a couple of years ago, maybe 3 years ago now, I think it was in January, the market dropped 10% in a month. And it gets your attention. I didn't sell any stocks, but none of them breached their sell lines in that time, and the market clawed its way back in the following months to get back up to where it was. But when the market drops 10% quickly, you certainly look at it and watch your portfolios and set your price alerts and things like that. But you don't change what you do. You don't sort of follow the herd and say the sky's falling in, well, I should go to cash completely, because if you did and you're out of the market and it turns back quickly, you've missed out.
There you go, Sue.
I suspect that, a lot of the metrics, the market's overvalued at the moment, and it wouldn't surprise me if we see a 10% correction. As you said before, with the ASX, it hasn't performed very well this financial year, because the other thing that can happen is it goes sideways for a long time. It just doesn't keep increasing at the rate it has been, which has been unusually fast since COVID. So it wouldn't surprise me if the market goes sideways, even goes down a couple of percent a month, for the next 6 months, say. That's kind of normal behaviour. We'll just keep investing the way we invest now. We won't change anything.
Good stuff. Well, there you go. That's a full lid, TK. After hours, apart from Succession, what's been taking your fancy lately?
Nothing to really recommend. I've gone on the Ted Lasso bandwagon on the weekend, so I've watched a few episodes of that. Quite fun, quite light and fun. And I did that because I watched the first 4 episodes of Foundation, the Isaac Asimov series, which has come out on Apple Plus.
Is it any good?
50-50. I'm a big fan of the books. I grew up on them and, listened to stage radio plays by the BBC and read the books from beginning to end probably 3 or 4 times and love it. Love the idea of science being progressed as a religion to spread it through the universe, all that kind of stuff. It was just so groundbreaking in terms of its ideas. This production is just lush. It's visually really good to look at, but haven't really got a handle on the script, I don't think. It jumps around a lot, which has always been the problem. It's very hard to turn, like a 3-volume series of books densely packed with ideas into a TV show or a movie. But yeah, not a bad effort. It's certainly worth watching and seeing if you like it.
It's my concern with Denis Villeneuve's upcoming Dune remake. It's the same thing. Like, grew up on those books, read them many times, huge fan. It's just really, really hard. I'm sure it'll be beautiful and lush, but, you know, whether or not it's going to have any sort of richness to the story, I don't know. We'll see. Very hard to do.
Exactly. Yeah. Yeah, I'm in the same camp. The Dune that came out in the 80s was flawed, but, gee, it was good. It's what you want from a book made into a movie. It adds extra dimensions to the story, you know. Everything doesn't look the way you picture it in your head, but it just adds to the book. It doesn't try and just turn the page and show you how that scene looks. It was good.
Talk about Lynch's version, yeah.
Lynch's version, yeah, definitely.
I'm a huge fan of that. I mean, it doesn't have a lot in common with the book, but it's well, I mean, the basics. But it's just such a crazy, messed up film. It's a lot of fun, really good fun.
Yeah, and a great cast. It's one of those movies where, like, you didn't know it at the time, but all those people went on to great things. Like John Patrick Stewart was in there, and Patrick Stewart, sorry, was in there.
Patrick Stewart.
Gurney Halleck, yeah.
Kyle MacLachlan,
obviously. Sting was in there. So,
yeah.
Great cast.
Yeah. All right. Well, I don't have anything to add. That's the show for the week. Hope everyone stays safe. Sydney, enjoying your newfound freedoms. Melbourne, hang in there. Another couple of weeks, Melbourne people. Stay safe. And hopefully we'll be doing some more QAV dinners around the country very soon.
Yeah. And any whiskey lovers out there, hit us up. We might go along to the Australian Whisky Association annual awards in January in Sydney.
QAV Australian Whisky Awards.
Yeah. Or at least the QAV table at the Australian Whisky Awards.
Yeah, all right.
Yeah.
Keeping an ear out for that. Thanks, mate. Have a good night.
All right. Thank you. Bye.
The QAV podcast is a production of Spacecraft Publishing Proprietary Limited, authorised representative of AFSL 520442, AFS representative number 0012922718. Please don't make any investment decisions based solely on listening to this podcast. This is presented as general advice only, not personal financial advice. We don't know your personal financial circumstances. Please see a financial planner before making any investing decisions.